If your bank suddenly delays a transfer, asks unexpected questions, or temporarily freezes part of a transaction, most people assume something must have gone wrong. But in many cases, nothing illegal happened at all. That is the part Americans still do not fully understand in 2026. Modern banking reviews often begin long before anyone accuses you of anything. And sometimes, they begin because your behavior simply changed in a way the bank did not expect. Not because you committed a crime, not because the amount was enormous, but because the pattern looked different from your normal financial history. To be clear, this is not about someone at the IRS manually watching your checking account. What usually happens is much quieter than that. Banks now operate under automated fraud prevention and compliance systems designed to detect unusual activity patterns early. And those systems react to behavior first, then context later, which means completely ordinary Americans, retirees, small business owners, parents helping family members, people moving their own savings, can suddenly experience delays, reviews, or verification checks without warning. Sometimes it is just a temporary pause. Sometimes it becomes a longer compliance review. And most people never understand why it happened in the first place. Because from their perspective, it was just a normal transaction. But from the bank's perspective, something about the behavior no longer matched the account's usual pattern. And once that happens, the account can quietly enter a review process most customers never even realize exists. Tonight, we are going to break down why normal bank transactions now get flagged more often, why two people making the exact same transfer can experience completely different outcomes, and the specific behavior patterns banks quietly monitor behind the scenes every single day. Because the reality is not just automated anymore, it is behavioral, and that changes everything. Let me show you how this actually happens in real life. A retired electrician in Nevada, 69 years old, same bank for more than 3 decades, same pension deposits every month, same grocery store, same utility payments, same predictable financial routine year after year. Then one Thursday morning, he walked into his local branch to request a cashier's check for $19,200. His daughter was buying her first home in Texas. He wanted to help with the down payment. Nothing unusual. Nothing illegal, just a father helping his family. At first, everything seemed normal. The teller smiled, typed a few things into the computer, then suddenly stopped talking. A minute later, the branch manager walked over and quietly asked him to step into a private office. And that is when the questions started. Who is receiving the money? Why are you sending it now? Has anyone pressured you to make this transaction? Have you received unusual phone calls recently? Have you met anyone online asking for financial help? At first, he honestly thought the bank was trying to protect him from scams targeting seniors. Then the manager explained the cashier's check would require additional internal review before it could be released. His daughter's closing appointment had to be delayed. He had to call her from the parking lot and explain what happened. 2 days later, the check finally cleared. But the review did not completely stop there. For several weeks afterward, his account remained under elevated internal monitoring because the transaction had triggered multiple behavioral alerts at once. And that is the part most people never see coming. The issue was not criminal activity. The issue was behavioral deviation. The bank's software saw a financial pattern that suddenly changed. And when that happens, the review process often starts automatically. Now, here is where the misunderstanding begins. Most people believe banks mainly look for illegal transactions. That is only partially true. In practice, modern compliance systems are designed to detect uncertainty first and determine intent later. Because banks are not built to instantly understand human context, they are built to reduce institutional risk. So instead of asking, "Why is this person doing this?" the software usually asks, "How different is this from what normally happens on this account?" That comparison happens constantly in the background. Your normal transaction history, your spending rhythm, your transfer habits, your average balance ranges, your past wire activity. All of it helps create a behavioral baseline over time, and once that baseline becomes stable, deviations become easier to notice. Which means a perfectly legal $3,000 transfer can sometimes trigger more attention than a routine $25,000 business payment, if the smaller transfer breaks your normal financial pattern more dramatically. That is why some people suddenly experience verification calls, temporary delays, extra identity checks, wire transfer holds, or unusual questions from branch staff, even when the transaction itself is legitimate. Because from the bank's perspective, the problem is not always the money. Sometimes the problem is uncertainty, and banks are under enormous pressure to investigate uncertainty early rather than ignore it, especially after years of regulatory crackdowns tied to fraud, elder exploitation, money laundering, and account takeover scams. So when behavior changes suddenly, the software often reacts first, before anyone fully understands the reason behind the transaction. And most customers never realize how much of that process is automated. Now, this is the part that matters most, because reviews are rarely triggered by one dramatic event. Usually, they come from combinations of smaller behavioral changes happening together. Here are some of the biggest triggers banks quietly monitor today. First, timing changes. Every account develops patterns over time: paydays, bill schedules, withdrawal habits, transfer frequency. And when that timing suddenly changes, the software notices immediately. Not because timing changes are illegal, but because sudden disruption increases uncertainty. Second, first-time behavior. The first international wire, the first large cashier's check, the first crypto-related transfer, the first large external payment. When the bank has no historical reference point, confidence drops automatically. Third, amount deviation. This is where many people misunderstand the system completely. It is not always about large amounts. It is about unusual amounts relative to your own history. Someone regularly moving $20,000 business payments may trigger no review at all. But a retiree who normally spends very little suddenly wiring $4,000 to a new recipient can trigger immediate verification, because the transaction breaks the account's historical rhythm. Fourth, stacked activity. Deposit, transfer, withdrawal, new recipient, short time frame. Individually, those actions may look harmless. Together, they can resemble patterns associated with fraud or account takeover behavior, and banks are trained to react cautiously when multiple unusual signals overlap. Fifth, third-party involvement, especially involving new recipients, unfamiliar accounts, or transactions under time pressure, because fraud targeting older Americans has exploded over the last several years, and banks are expected to intervene earlier than before, which means millions of ordinary people quietly experience internal reviews every year, without ever realizing it happened. But here is the part most people never expect. Two customers can make the exact same transaction, for the exact same amount, at the exact same bank, on the exact same day, and receive completely different treatment. One clears instantly, the other gets delayed for days. And the difference often has very little to do with the transaction itself. It has to do with the financial behavior already attached to the account before the transfer ever happened. And once you understand that, you start realizing why some completely ordinary Americans suddenly experience banking friction without warning, while others never notice anything at all. Take two retirees, same age, same bank, same $15,000 transfer to help family members. One clears in under an hour. The other enters extended review. Why? Because the bank is not evaluating the transaction by itself. It is evaluating context. One customer may already have a long history of wire transfers, larger average balances, established recipient history, or regular high-value movement patterns. The second customer may have none of those things. So internally, the confidence level attached to the transaction becomes completely different, and once confidence drops, processing slows down. Not necessarily because the bank believes something illegal happened, but because the bank cannot immediately confirm that the behavior fits the account's normal pattern. That is why some people experience temporary holds, extra questioning, identity verification, or delayed transfers, while other customers moving similar amounts experience nothing unusual at all. And once an account enters elevated review status, future transactions may temporarily receive additional scrutiny too. Not as punishment, but because the bank is now evaluating updated behavioral context. That is why some people suddenly feel like, ever since that one transaction, things have been different. Because internally, the account's behavioral baseline may have shifted. Now here is the uncomfortable reality banks rarely explain clearly. Modern compliance systems operate under asymmetric risk, meaning banks face far greater consequences for missing suspicious behavior than for temporarily inconveniencing innocent customers. That changes everything. If a bank reviews an innocent transaction unnecessarily, there is usually little penalty. But if regulators later decide the bank failed to detect suspicious activity, the financial penalties can be enormous, sometimes millions of dollars. So banks naturally build systems designed to react conservatively whenever uncertainty increases, and that is why retirees, small business owners, parents helping family, or completely ordinary customers sometimes experience reviews even when nothing illegal occurred, because the software is not making moral judgments. It is making probability calculations. And from the customer side, that can feel deeply personal, especially when nobody fully explains what is happening. So what can people realistically do? Financial professionals usually recommend 3 simple things. First, if you know a large or unusual transaction is coming, document it ahead of time whenever possible. Bills of sale, wire instructions, invoices, closing paperwork. Written records help create context if the bank later reviews the transaction. Second, avoid stacking multiple unusual activities together unnecessarily. Large transfer, brand new recipient, cash withdrawal, different branch location, multiple rapid movements. When those things happen together, review likelihood increases dramatically. Third, if your bank suddenly asks questions or delays a transaction, do not panic immediately. Most reviews begin as automated risk evaluations, not criminal investigations, and how calmly you respond during verification matters more than most people realize. Because once financial behavior changes, banks often temporarily compare future activity against that updated baseline. And understanding that process now matters more than ever. The reality is, most Americans still believe financial monitoring only applies to criminals, massive cash deposits, or obvious fraud. But modern banking systems increasingly evaluate behavior long before intent is fully understood. And most of that process happens quietly in the background, without customers ever seeing it directly. That does not mean ordinary people are being treated like criminals, but it does mean financial behavior today is interpreted very differently than it was even 10 years ago. And the people who understand how those systems work are usually the people least shocked when unexpected banking friction suddenly appears. If you want more breakdowns like this, where banking rules, compliance systems, and financial behavior are explained in plain English without panic or clickbait, subscribe. Because in the next video, we are breaking down the exact transaction patterns banks quietly classify as high uncertainty behavior, even when the money itself is completely legitimate.